Welcome to Accounting in Focus. Today I want to show you how to record the journal entries for the purchase and sale of inventory. And today we're going to do it under the FIFO method. So we're going to run through the FIFO calculations and then we're going to show the journal entries that you would do in order to record the purchase and the sale under both periodic and perpetual inventory. So let's do the calculations first. And then after we do the calculations, then we can go back and do the journal entries. So under FIFO, FIFO stands for first in, first out. Okay, we call that FIFO. Now, whenever I'm trying to remember different things in accounting, I always try to relate it back to something that I know in real life. So when I'm thinking FIFO, I think of buying milk at the grocery store. Think about how they stock milk at the grocery store. When people buy milk and they have to restock the shelves, what they normally do is they take the old milk and they push it up towards the front, towards where the customers are, right? And then they put the new milk in the back. Because what they want is they want people to buy the older milk, right? The first milk that they got. They want them to buy that first, right? So that it doesn't go bad. So the first milk that is purchased is the first milk that they want to sell. First in, first out. Now, the nice thing with FIFO is that FIFO is the same whether you're using periodic or perpetual. So this is going to be exactly the same whether it's periodic or perpetual. So that's kind of nice. You only have to do one set of calculations for that. Okay, so let's figure out for the dates the items were sold, how much the inventory would be associated with that purchase. So on 1/4, we sold 100 units. Okay, so remember, first in, first out. So we're going to look to the units up here, okay, our beginning inventory. So there's 200 units in that beginning inventory. Okay, so we need 100 of those for that sale. So I'm going to take 100 units at $1 each. And that's going to be $100 total. Now when I'm doing these, I like to kind of mark off what I've taken. So there aren't 200 units here anymore. Now there's only 100 units here. Okay, because we used 100. So now on 1/12, we sold 150 units. Okay, so now let's go back up to the top. We've got 100 units here. Actually, I can change the color. I've got 100 units here. Okay, so we'll take those first. So 100 at $1. So that's $100. And then those are gone, right? So we don't have those anymore. Ooh, those are gone. Okay, so I still need 50 more units, right? Because we sold 150. So I'm going to take 50 units from here. Okay, because that's the next purchase. So I've got 50 units at $2 each, and that's another $100. So the total for the sale on 1/12 is going to be 200. Now again, I'm going to update my numbers. So I took 50, so I have 100 left. Okay. So now let's go to the 29th, and I'll use a different number for I'll use a different color for the 29th. On 1/29, we sold 100 units. Okay, I've got 100 units left from the purchase on 1/3. So I've got 100 units at $2, and that equals 200. Okay, so now if I added all this up, my cost of goods sold for the month of January would be 100 plus 200 plus 200. So we could say cost of goods sold equals 500, right? Because that's 100 plus 200 plus 200. Okay, so now what's my ending inventory? Okay, ending inventory would be what we have left, right? So we have the items from 1/9 and the items from 1/18. So this is what's left. So ending inventory, okay, ending inventory is equal to 100 at 3, which is 300, plus 50 at 4, which is 200. So if you add those two together, ending inventory is 500. Okay, so you got 500 there. So now that's what's left over at the end, right? Cost of goods sold goes on our income statement, and ending inventory goes on our balance sheet.